Glad to have you with us. Today we're going to talk about the final video on rental property, and that is selling your property and calculating your gain or loss on the property. So you start with your original basis that we talked about in video 2. If you haven't watched that video, you need to go back and watch it on how to build that original basis. You'll subtract out any depreciation that you've taken on the property. That would be bonus depreciation, accelerated depreciation, usually straight line depreciation if we're talking about a rental property. And then you're going to add back any selling fees like realtor commissions, recording fees, title insurance, attorney's fees, and any other fees that you might incur when you sell that property. If you're doing it, if you're carrying the note or doing an installment sale, you may not have that many fees, but make sure that you take into account your fees to come up with that adjusted basis. Now remember in our depreciation video that we talked about rental property and dividing the structure from the land because the land could not be depreciated. Well, you've probably also added some things in there, possibly like a refrigerator or appliances of some kind that will also need to be depreciated. Those things are depreciated on a different basis than what your rental structure is. And so it's a good idea to separate these things out. In fact, you need to separate them out if they've got, certainly your personal property needs to be separated out. And it's a good idea to separate out your land from your building because sometimes you can have a tax savings when you do that. So that's not only on the purchase end, but it's also on the sales end. So allocate your sales price by your different types of property and then calculate your gain or loss by the type of property. And it's a good idea to do this. A lot of people and a lot of CPAs and tax preparers don't do it as far as the land goes. They will do the personal property but not the land. And it's a good idea to do the land as well. So you can see on this slide your selling price minus the adjusted basis of the building is going to give you the gain or loss on the structure. And you're just going to have to allocate those things. Your adjusted basis of the personal property, you don't have to allocate so much because you know what that costs and you're setting that up on your depreciation schedule as you've gone along. And then on your land, you do have a price that you've separated out on the front end of your land, and so you'll have to allocate part of the sales price to that as well. And it should be as much, you can allocate as much as you can possibly do, but it should be based off fair market value and be reasonable when you make these allocations. So let's look at these allocations between the personal property and the real property a little bit more and talk about why it's a good idea to break out the land on the sales end as well. First of all, your personal property is going to be taxed as ordinary income. So if you've got a gain on personal property, it's going to be taxed as ordinary income, and that's known as a 1245 property, okay, Section 1245. Your land and your other real property are going to be taxed at capital gains rates, and they're known as 1250 properties or Section 1250 properties. Now, the way the savings comes in is if you've depreciated a great deal of that building, and you need to realize that depreciation is recaptured. The IRS has given you a break on that depreciation for many years, and now they want you to, they're going to want to charge tax on the amount of depreciation that you've taken. Well, depreciation is recaptured, straight line depreciation on rental property anyway, is recaptured at a 25% maximum gain rate. If there's any gain left over after that depreciation recapture, then that's taxed at a 20% capital gain rate. So by dividing the land out, you may be able to, it may cut in, especially on buildings that are nearly depreciated, it will cut into the amount of recaptured depreciation that's at a 25% gain rate and put it at a 20% gain rate. And so it is possible to save taxes in that area. So keep that in mind, and you want certainly if you can get a 20% gain rate instead of a 25, it's worth doing. Now, if you have a loss, you don't have to worry about depreciation recapture or anything. You just have to categorize the loss as to whether it's short-term loss or a long-term loss. And you saw on the slide earlier that if you've held the property more than a year, it's going to be long-term. And so that's a pretty easy decision. So take that into account, and then you just take your loss. Now, many rentals are sold through self-financing or installment sales. An installment sale is a sale where you receive your income in more than the current year of the sale. For example, you might receive a payment in 2019 and then another payment in 2020. Now, I don't advise that you ever do this. I think just keeping it as a rental is much more advantageous than having an installment sale. But if you're just in a hurry to get rid of the property, and just remember you may get it back again, but it is one way to sell property. And when you're dealing with taxes, then there are some differences in the way installment sales are held. And basically, you calculate what's called a gross profit percentage on that. You divide the gross profit that you received on the sale, and you'd come up with that gross profit pretty much the same way as you do a regular sale. And then once that gross profit percentage is then you multiply it times the principal that you receive over the next 20 years, or whatever the length of the loan might be. And so if you've got $1,000 and you're a month, and that's your principal payment for the month, and you have a gross profit percentage of 30%, well then $300 of that $1,000 payment is going to be taxable for that month. And so if you've got 12 months of that, you've got $3,600 that's going to be taxable for the year. And then you have to remember that the interest is also taxable. The interest is not handled on Form 6252, which is the installment sale form. And so that's reported on Schedule B, just like any of your other interest. But keep in mind that you have to have the person's name, social security number, and address, because it is a seller-financed mortgage, and that's what the IRS wants to see on Schedule B. So that's installment sales. Like I say, I don't like them, but a lot of people are doing them, so you'll have to make up your mind when you're selling the property. A couple of other things to note about installment sales is you can't use them for losses. They're not going to let you spread your losses, and they don't work well with related parties. So if you're going to sell to a related party, you're going to have to really prove that there's a reason for it, and that this is an arm's length transaction action. So forth. To conclude here, sales of rental properties can be a little bit complicated. Just make sure that you have your original basis calculated right and your adjusted basis. And look at splitting them out and splitting out the land, because it can result in tax savings. And if you like this video, give me a thumbs up and subscribe to the channel. And good living until next time.